Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joe Davis joins us here, Global Chief Economist and Global Head of Investment Strategy at a little shop down there in Philadelphia called Vanguard. Joe, what did you make of Fed Chairman Jay Powell's comments about rate policy, maybe the December meeting? What was your takeaway from yesterday?
Well, I think he's trying to really thread a needle. I mean, we've clearly downshifted on the labor market. Not all of it is because of weaker demand, but you got inflation sticky. And then a third factor that I don't think, they're talking enough about, but probably will, and that is the prospect of asset price inflation. You look at the equity market. So I think they're trying to feel a way here in a data blind spot.
So what about that dual mandate? We're talking about inflation, the stabilization of prices, but then also maximum employment. How are you viewing this right now?
Well, again, our view was that they would weigh the job market over the inflation. This has been generally a modestly dovish institution, at least in recent years. Not a criticism. I think it's just a reality. And you also have to at least make some assumption that some of this tariff-induced inflation, will dissipate. But the risks are growing. I think that's why you're seeing some dissent at the Federal Reserve. It's actually somewhat commonplace once you get to close to where you think you should be. And we're definitely in that zone.
Hey, Joe, we're right in the middle of tech earnings, and the numbers continue to really impress us in terms of how much money these companies are spending on AI. How does that impacting the broader economy? Do you guys kind of take a stab at that?
Well, yes. In fact, we spent over 3 years really looking deep at where the economy, how could it be affected as AI broadens? And it's not a foregone conclusion, but I think in 2 or 3 years, in our data-driven framework, there's a possibility that we're growing at 3% real GDP, which I have not seen many firms or economists talk about. And again, you have to be cautious, right? There's going to be overinvestment in this cycle, even if AI is as transformative as we think. So you have to feel your way here, but we are not in bubble territory. And this could really accelerate over the next 2 years.
So cautious in the corporate tech space. What about consumers? How are we thinking about tariff-related inflation? Are you seeing any of that right now?
You definitely see it in households, particularly those at the lower income brackets. That's not new. It's been there. It's where you also see some of the wage growth that had slowed for a time. Yet you have higher income households, which again is not new, really supported by just the past 5 years. The increase in wealth in housing as well as the equity market is really a source of cushion. But you do see that bifurcation, and I don't think that's going to change in the near term. What's going to be key is, do we see a firming in the labor market in 2026? That's our expectation. That's what our own indicators of Vanguard show right now, given our proprietary data. But again, there's still some tariff uncertainty to work through here.
And Joe, on the labor front, I'm one of those people, these early stages of AI. I just feel like AI is going to be a net negative for the U.S. labor market in terms of absolute bodies needed in it to fuel this economy. I know it's early, but do you guys have an opinion on that?
Yes. Again, we started work, believe it or not, on AI in the future of work. I can't believe it's almost a decade ago. What we continue to find and expect, it's been a learning process for all of us, is that in roughly 1 in 5 occupations over the next 3 to 5 years, I'm not going to sugarcoat it, you're going to see jobs start to decline. But for every job that declines, there's going to be 3 that benefit. But this is going to be disruptive. In our baseline expectation, we see the most disruption in terms of how we spend our day at work changing in at least 25 years. And so there's going to be anxiety along with some of these efficiency gains. More workers will benefit than not, but there is going to be some disruption here. And that's a clear result from our work.
I mean, how are you thinking about job opportunities coming from that, or potentially lack thereof? I mean, if you think about the tech space right now, you hear people who are coders even concerned about being replaced by AI. How are you thinking about that on the long term?
Well, again, that goes to my, I'm not going to sugarcoat it. There's going to be some industries where you're in occupations, you're going to see some pressure. Again, it's almost like you have to pick like which issue to effectively deal with. The fact is for the past 10 or 15 years, in the U.S. economy and most developed markets, we've had a lack of automation, which is why growth has generally been low. And some of the wage growth outside of COVID was fairly tepid. And so, with disruption comes the prospect for productivity, higher wages, but that comes with change. I mean, we've seen that throughout history. And so we have to think about which world we're entering. It's more likely going to be a disruptive one, higher growth, but it's not all boats will be lifted at the same time. And it's just, I'm not gonna, it just is what it is. That's clearly the diagnosis.
Joe, how are you guys dealing with the fact that you're not getting a lot of government supplied economic data with this shutdown? Are you just kind of trying to find the best alternative data points out there?
Yes. I mean, like everyone, we have our own indicators. We know, for example, job growth, because if you're in a 401k plan, and if we're the administrator through auto enrollment, like for your actual retirement plan, we have some sense of new jobs being created, even promotion rates in real time, in clearly an anonymized way. It's not perfect because we clearly are not the only 401k provider, but nevertheless, it's another indicator that we can look at. And again, there's other data points out there from other firms, job posting websites. So I think we always look at it as a distillation. Again, it's right now those indicators that we have are holding constant. They're not super rosy, but they're not negative. And so that would point us to that the labor market should firm here. But that's the key indicator for the next few months.
Now, if you're wondering why Joe is such a smart guy here, and is because he got his master's and his PhD at Duke University. See? You see what I did there? So yes. And he did his undergrad at St. Joe's.
I knew you were going to work that in. You got to say Duke.
Absolutely.
You got to elongate to you.
Absolutely. Joe Davis, thanks so much. We appreciate it. Joe Davis, Global Chief Economist and Global Head of Investment Strategy at Vanguard. Now, when you're a graduate student at Duke, it doesn't matter what school you're in, you don't have to camp out at night for Duke tickets. You just do it once, the beginning of your graduate school career, one night.
Okay.
And then you get to keep those season tickets for your entire graduate school career. You don't have to do it every year. So if you're one of these PhD people in like philosophy, it takes, stretch out over 8 years, you got your season tickets guaranteed.
Because all the undergrads have to sleep out
They have to sleep out for every game.
Oh my
We just
goodness.
have to do it once. That's because we're professional graduate students. So that's kind of
earned it, right?
Oh, do they hate us for that? The undergrads. We get a lot of grief for that. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Heidi Crebo-Rediker, she's the Adjunct Senior Fellow at the Council on Foreign Relations. She joins us here. Heidi, thanks so much for joining us here. A lot of headlines, a lot of tweeting coming out of Asia here. It was a long trip, a week in Asia, many countries, concluding, maybe highlighting with a meeting yesterday with Xi Jinping and President Trump here. What's your takeaway from President Trump's Asia trip?
So first, I think that it was a very positive trip all the way around. So this is a big feel-good moment for Trump, and it takes the temperature down on trade, particularly with the meeting with Xi Jinping. No big surprises in that agreement. The contours of the framework agreement were pretty well telegraphed. But I think short term, good trip. Longer term, I always pay attention to the strategic direction of travel in the U.S.-China relationship, and I don't think that has changed. So as long as, for example, China keeps supporting Putin's war machine and threatens not only Taiwan, but other Indo-Pacific partners, then we're going to have a bumpy ride ahead for the rest of the presidency and beyond. So we always have that issue of dual-use technology. And even though the China hawks in this administration have been pushed back, I think particularly around export controls, as long as China continues a trajectory with swamping global markets with manufacturing and dialing up or dialing down, but dialing up their own export controls on rare earths and related technology. It's going to be a complicated relationship. And so I think in the longer run, we have a clear direction of travel. It's not going in the right direction.
So a short-term fix here, or Band-Aid, if you will, but what are some of those other deeper structural issues between the U.S. and China that you believe need to be resolved here over the long term?
So I think we have, there are the deep structural tensions in the commercial and economic relationship that we have with China. And, they're flying ahead in terms of their innovation and capacity to actually really implement a lot of the strategies in advanced manufacturing that, they've just doubled down on with this latest 5-year plan on their desire to just be an even greater tech giant on the world stage. And the export controls on rare earth. I was in Shanghai last week for the Bund Summit, global summit. They're global. Those export controls, they're here to stay. And the Chinese are very, very confident. They're enjoying this checkmate moment. And so I think we'll see again these export controls on rare earths dial up, dial down. It's asymmetric leverage. They have the ability to shut down industries of basically every country in the world with manufacturing. So I think that is the big picture moving forward on the strategic side.
Heidi, it seems, I don't know, maybe over the last 10 years, maybe even longer, kind of a development of a technology Cold War between China and the West. And at one point, it seemed like the U.S.'s policy was, let's ally ourselves with everybody else out there against China and Trans-Pacific deal. Then it seemed to be a little bit of America first, and we'll take it on solo. How do you think America and the West should deal with China going forward?
So there were a lot of European experts, economists, financial leaders at this summit in Shanghai last week, and they were distancing themselves from the U.S. and saying that they want no part of these export controls on them. In terms of how the U.S. moves forward, we have obviously taken the Trump administration is not multilateral in its approach to really anything except for critical minerals and rare earths. So there is no way to develop any kind of capacity without friends and allies. We've seen big deals with Australia. We've seen the initiation of deals with Ukraine, DRC. The one big missing piece is in Japan. The one big missing piece is Canada, which of course could be one of our greatest friends when it comes to the critical minerals puzzle. So I do think you'll see this on the G7 agenda. You'll see investment in technology to sort of leapfrog some of the China chokeholds, but we can't do that by ourselves.
So what's your takeaway on the soybean purchases situation? I see here you say that it was symbolic, but made good mood music. Talk to me about that.
So I do think that, so far the volume that we know about has been minimal. We don't know what the details of what Trump's massive amounts agreed actually mean. So we have to wait and see where that goes in terms of how much and whether or not the Chinese actually follow through. Really important to U.S. farmers to actually to really get this fixed. And the shipping fees that we had, the tariffs on Chinese ships. If we're moving agricultural products to China, we don't actually, we use Chinese ships to actually ship a good deal of our products because they dominate. So I think it was symbolic. They wanted to, Beijing wanted to create a constructive atmosphere for negotiations. And, I think, they did get tariff relief and some renewed agricultural trade. But we have to see what's in that deal. China already is well stocked for agricultural goods, and South America is really set with a strong harvest. So we'll have to see whether it's near term upside for U.S. soybean producers or whether it's just, whether it'll be durable.
I'm not even sure I'd know a soybean if I tripped over one, but
not at all.
They're very important here. 12 million metric tons, 25 million metric tons. I don't know what's
right. We said it about 1,000 times all morning.
All right, Heidi Crebo-Rediker, thank you so much. We really appreciate getting your thoughts there. Heidi Crebo-Rediker, she's the Adjunct Senior Fellow on the Council at Foreign Relations. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We've got earnings coming in pretty darn strong. That's a good thing for risk assets, I would think. So what are we doing here? Let's talk to somebody who gets paid to think about that stuff. Adam Farstrup, he's head of multi-asset for the Americas, where else, for Schroders. Adam, it seems like we've got a pretty constructive backdrop for risk assets here, again, with earnings, with presumably an accommodative Federal Reserve. How are you guys thinking about allocating assets here?
Yeah, I mean, I think it's in some ways, I talk about being a broken record because really since Liberation Day, it has been right to be long risk assets, particularly equities.
Yep.
We had at the beginning of this year, you had a bit of the sell America trade, right? We saw Europe really doing well. That shifted to emerging markets. Emerging markets continue to do well, but the key shift was over the summer coming back into the U.S. equity market. And from here, we still see strength coming through the U.S. and actually emerging markets where earnings are supporting things. So the valuations, clearly not something that makes you really comfortable at night. But as long as we continue to have these earnings come through, we think investors should stay risk on.
So what about the fact that the data has been sparse? How have you all been navigating that, given the fact that we're experiencing a government shutdown?
Yeah, I think our economists are wondering what they do with their day because they're waiting for that data to come in. They keep canceling meetings with us. No, we're really focused on the same kinds of alternative data sources that you see the Fed talking about. You look at, we still have high quality pieces of information coming out from, say, Atlanta Fed, the GDP Now, which is showing you that the economy continues to grow. And even if GDP Now is not always the most accurate assessment, you look at that sort of bracketing almost 4% growth for the quarter, with consensus estimates around 2%. Let's say the GDP growth is falling somewhere in between there. That tells you you're still in a supportive growth environment, and we're not seeing the unemployment data really tick up at this point yet. But it's a real knife edge for the employment market. I think that's one of the challenges we have right now.
In the markets, in the equity markets, one of the concerns is equity market concentration. I'm looking at your notes. It says it's higher than we saw in the tech bubble, but I like this. We think investors should be wary and not fearful. What do you mean by that?
So we think in these periods of technological change, it's not unusual when you look through history to see concentration in markets. So the concentration within the U.S. equity market means you need to be active. You need to understand the companies that you're investing in. I would be leery of just buying beta right now, as opposed to having a view on the stocks that you're buying in the market. So that's point number one. But point number two, that I think the concentration we're more worried about is the degree to which capital markets are oriented towards the U.S. right now. And that has been kind of the big challenge as a multi-asset investor, as an asset allocator, is how do you diversify without being dramatically underweight what has been a high ROE, high returning market in the U.S. And so we think looking towards global approaches, capturing some of the real dynamics in emerging markets where, if you say you want to play AI and you think that trend, that technological change is going to continue, the place to play it is not Europe, it's emerging markets. That's the other strength outside the U.S.
So where in emerging markets are you looking? Where do you see the most opportunity?
Yeah. I think it depends whether you're talking about debt markets or equity markets. So in equity markets, there is, China is a real complex situation right now. The domestic consumption in China is still weak. The economy is being managed, I think, to some different ends than we would traditionally see in the U.S. But if you look at sort of exports are picking up out of China. We just had the deal overnight announced between the latest deal announced between the U.S. and China. We think that starts to push out into countries like Taiwan and Korea, where they're sort of involved in that supply chain. The tech names within China are very interesting to us as bottom-up investors. Talking to the bottom-up teams within Schroders, they get very excited about that. When you talk about the debt markets, here what's interesting is you've seen very high yields in economies where the monetary policy has been managed in a very traditional way. They've been on top of the inflation pressures. And so we have this monetary supportive cycle that is backing investors in Latin America in particular, where we see a lot of opportunities for real yields.
I like having these multi-asset pros in here because you can ask them about anything. Just
I
throw
love
out
it.
whatever sticks on the wall here.
Just about growth or
I'd love
anywhere.
to get your call on gold here. It just had this incredible rip up to 4,300. We've had a little bit of a pullback here. We're sitting just below what some folks will tell me is a kind of support level around 4,000, 39.90. What do you guys make of what's happening in gold this year?
Yeah, I think gold is highly related to the fears about what might happen in change in policy in the U.S., right? And so when we talk about diversification away from the dollar, it's not that the dollar suddenly loses its reserve status. It's really that we see a need for central banks to diversify their holdings. We're seeing demand for physical gold in places like China and India. So we just think this is a consolidation into the next leg of a rally as investors see gold being very valuable in portfolios for resilience, not a hedge.
Yeah, at least Mateo buying gold at Costco. That's what's going on. Adam, thank you so much for joining us. Adam Farstrup, he's head of multi-asset allocation there at Americas for Schroders. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's see what we're doing in the credit markets these days. Meghan Robson, head of U.S. credit strategy for BNP Paribas, one of the greatest offices in Paris. It's the BNP Paribas office. It's just awesome. Meghan, thanks for joining us here in our Bloomberg Interactive Broker studio here. What did you take away from the Fed's actions yesterday?
Yeah, so I think that the commentary from Chair Powell, as you said, was a bit more hawkish. So you came in and the market was pricing a very high probability of getting a second rate cut in December. And, he said it's not a foregone conclusion that we're going to do that. There's still, haven't had much data with the government shutdown. And so he did leave things a little bit up in the air and indicated the committee is a bit divided. For credit, though, I think, investors are still just focused on the broader easing bias. So they did announce an end to quantitative tightening, which would start December 1st. So that, that's a positive. That's easier conditions. And whether we get a cut in December or January, I think still positive for credit markets. So not a huge driver of price action for us, I expect.
So not as much data that we've received this month as we've been in a government shutdown, but how is your team thinking about the balance between inflation risks and growth concerns as we really think about assessing, credit spreads, for instance? It's
a great question. So I think with the last CPI print, we did get a little bit of relief, and there's some indications that inflation is not yet accelerating. And the Fed has told us that they want to prioritize the growth pillar. And so in our view, we think that the Fed, even if inflation does look a little bit sticky, is going to prioritize that and let things run hot. And for credit, that's actually a very bullish outcome. You potentially have front end rates coming down and then letting the economy run a little bit hotter. So it would be positive for the credit markets.
All right, where are we taking credit risk out there, Meghan? I'm looking at the INGO function, which they've reconfigured, so now I have to relearn this one. But we do have some really positive returns there in the corporate ag, 7.87% for the Bloomberg U.S. Corporate Aggregate Index. We own it. Great returns in credit.
We have a preference right now for high yield over investment grade. And, as you've also probably seen, there were some headlines related to recent credit bankruptcies that came across. And I think we think those are idiosyncratic, but they really harmed high yield credit spreads a bit more than investment grade. So you're seeing those spreads trading a little bit wider. Single Bs in particular, we think look wide. And if we do see earnings as a good indicator of growth ahead, I think that segment could really outperform.
Are corporate balance sheets still resilient, or are we starting to see cracks there?
So far, leverage has been very stable for a few quarters, and that's been supported by two things. One, debt growth has been relatively low, so you have these high rates, and issuers, all else equal, are less likely to borrow more debt. And then the second pillar is earnings. Earnings has been very strong. And, we thought by now that potentially you would see some of this, the tariffs start to pass through to margins, start to harm the bottom line. But so far, we're not seeing it. Earnings broadly has been quite strong. So leverage, corporate leverage that we focus on, cash to debt, all very strong metrics. I think the question for 2026 will be, do we see a pickup in M&A? Do we see some of this AI CapEx funded through the debt market and have that story change? But for now, balance sheet's still very resilient.
How do you guys allocate to private credit?
So private credit exposure, you can gain exposure through the business development companies. So there are some publicly traded BDCs that investors can gain exposure to credit. Our view is that we like the debt of BDCs. So they sell bonds. You can buy the credit. And then there's also the equity component. The equity has struggled recently because of rate cuts and also some of these headlines around single name credit. But in our view, we think that the credit spreads of BDCs look attractive here and are worth considering to add risk.
What sectors are looking most vulnerable to you in terms of, maybe potential refinancing risks, especially given the high rate environment?
So I think we are watching the K-shaped recovery. I think sectors that are more exposed to lower income consumers. So think about auto lenders, subprime consumer lenders. Some of the retail sectors are a bit more exposed, and we are seeing, the few defaults that we have seen recently in the headlines have been in those areas. So we like avoiding those areas. In areas that we like more, we do like exposure to cyclicals. So one of our top trades is an overweight to U.S. autos. That's done very well. We think if we do have this kind of hotter economy scenario that we're talking about, that cyclical premium should tighten.
Where's the risk out there in the credit markets here from your perspective? Because I haven't really seen it. I mean, credit quality seems pretty solid. Liquidity seems okay. What's the concern for you out there?
Yeah, I think, we would watch for a growth slowdown. I think, earnings has really been buoying everything up. And so that would be one scenario we're worried about. Or, to the discussion on inflation, if we saw a reversal and really an acceleration of inflation, if it changed the Fed's posture on easing and we ended up getting rate hikes, I think that would be something that would also concern credit markets.
Meghan, thank you so much for joining us. Really appreciate it. Meghan Robson, head of U.S. Credit Strategy at BNP Paribas.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.